Good morning. My name is Brad Olson with Oak Tree Financial Services. I want to welcome everyone today to our quarterly update where we kind of go over a little bit of what's going on with the economy, talk a little bit about what's trending as far as topics, and just kind of give you a little update of where our thoughts is as far as what's going to go on in the next quarter. So I'd like to thank everyone for attending. We're going to try to keep this to a half hour and try to keep it fairly efficient. So some of the slides I'm going to go through fairly quickly. So if you want to have further follow-up, feel free to give me a call and we can go into further detail. So if you have any questions, feel free to submit those. We do have a Q&A that you can go ahead and submit into. So let's take a look. Some of the things that we're going to cover today, we're going to take a look at some of the storm clouds gathering on the horizon. We'll review a little bit what's going on over the past 3 months. Inflation, some of the levels that we're seeing there, what's happening with Ukraine, consumer sentiment. Again, if you have questions, feel free to submit those via the process that we have with the Q&A. Just hit the Q&A. So feel free to do that. Also, I just want to let you know we do record this just so we have it. If anybody wants to get a follow-up file of this, we do have it available. And again, thanks for attending. As always, we're in Bishop's Woods. We're sitting down with clients on an ongoing basis to go over portfolios. So feel free to stop in anytime and say hi. This is where we're at, and you can see our phone number. And also, I mentioned the website. We do have a lot of information on the website. We'd like people to take advantage of that. It is something that we've put a lot of time in to make sure that there's a lot of information that is kind of timely that can help you from the standpoint of keeping up what's going on in the financial world. Also, when we take a look, I want to make sure that we have some ongoing projects that we're working on as far as here at Oak Tree Financial Services. One of the things I'm getting very adamant about doing is making sure, and I hope not to drive everyone crazy who is a client with this, is making sure that we have our review dates in a structured basis. Andy is spending a lot of time. Andy Smith is kind of my right-hand person here that spends a lot of time on making sure that our reviews are going to be done and we have a schedule to do that, because it's very important that we're communicating, especially at this time. Also, some things we mentioned on the bottom here, some things with client records. We're working on those at the current time, just making sure we have updates of beneficiaries, making sure we know your trusted contact, all the bank information if we have standing instructions and things like that, wanting to make sure that all of that is current, which is very important to us. So let's talk a little bit about, I'm not going to spend a ton of time talking about the past, but just a little recap of what happened in the first quarter. If you take a look at the first quarter, what we did see that the markets were down. So overall, if you see what the Dow did, we're down about 3%. The NASDAQ was down about 8%, and the S&P down around 5%. So it was a tough quarter. Plus, another part of this that we do want to highlight is also we see that bond rates, we did see that the bond rates range from 1.74 to about 2.35 on the 10-year. Also, what that does to your bond holdings, it does decrease the value of those on that math that we do on a daily basis when we're valuing bonds in your portfolio. So we did see that overall, it was a tougher quarter because we saw a lot of the equities didn't do as well. Plus, we saw that the bond market with current bonds, when you have rates go up, the bond values will go down. So we're always trying to tighten up those holdings to make sure we're in low duration, stuff that may have some more ability to react with inflation. Now, if you look at over a period of time, we've seen that the numbers here are pretty solid. When you look at the 3 and the 5-year numbers, it's been a pretty good run. Now, that will also integrate back into my talk as I go forward here when we take a look at, PE ratios, what are the price to earnings ratios, how have they increased because of the market runs that we've had. So next, I'm going to cover very quickly the next couple of slides. Actually, I'm going to spend no time on these. If you want to get our disclosures, we can send those to you, but I have to quote all of the areas where I put this data in from. So that's what these slides are about. So we're going to go through these real quickly, but we do have to make sure that you see those. So let's talk a little bit now about what's going on with the economy. And as I mentioned, I did kind of title this "Storm Clouds Are Gathering." There's things that I look at. Now, again, some of these charts and graphs, I'm going to go through fairly quickly. I'm going to try to give you a highlight of what that chart or graph means. And I'm not going to spend a lot of time going over each statistic on it, but just trying to give you an idea of why I use this. Again, our whole basis of setting up portfolios is based on three things. One is when we're looking over at kind of what your risk tolerance is, what your time frame is, and then where are we at in the business cycle. So your asset allocation is going to be based on those three factors. So when we're looking at putting the portfolio together, one is we're going to have an asset allocation based on your risk tolerance, your time frame, what your goals are. We'll try to make sure that those are implemented into that. Then the other part of that formula is going to be where are we at in the business cycle. What these charts and graphs will do is tell us where we are at in the business cycle. And that gives me an indication of where we want to emphasize or de-emphasize. Now, again, when you're looking at this, I'll put a disclosure and a kind of a thing that I think everyone should talk about in this business. This is not a science. This is an art form to a degree. We interpret the numbers the best we can. I'm going to talk about the Fed and some of the things that they've done over the last year or so. You'll see that we have some pretty smart people in the Fed, at least educationally smart. When you look at what they're setting out there as far as policy, they don't know. I mean, because so much of this is reacting in real time from the standpoint of you don't know what the medicine that they're putting out there to affect the economy, how that's going to affect the patient, which is the economy. Some of the things that you do may not have, it's like a doctor. They have the best intentions as far as giving you a certain medication, but the question is going to be each individual and each individual economic situation is going to be a little bit different every time you give it different medicine because the dynamics are different. So it is something that we're looking at on an ongoing basis. First of all, let's take a look a little bit about commodity consumption and production. Basically, what I'm trying to say here is when you look at the chart over here, what I'm looking at here is, now historically, when I look at consumer spending on energy and food, in relative terms, if you go back and look historically, back over these years, it is a relatively low amount that we are spending currently. So when you look at energy, we aren't quite spending as much on energy as maybe we think we are right now. Now, the question is, what is this going to increase to? Because you see it is blipping up here. So how is that going to affect the consumer, which is 70% of our expenditures? Also, when we look at over here, there is some good news. Our net imports of oil over a period of time have come down substantially. I mean, you go back to us older people that have been around for quite a while. And again, I was somewhat young back in here. But when you look at what's happening, when you look at how much our energy sources, where they come from, we have decreased our imports of energy supply. So the good news is we have brought that down of what we're importing. The bad news is it has spiked up a little bit. So the question is, and again, I leave all political comments off to the side on this. I try to deal in facts. Again, we always call it the Joe Friday rule, just the facts, man. So what we're looking at here when we do this is say, are the policies that the administration has implemented when it comes to energy, are they changing the dynamics? And it can be debated a little bit, but it is changing the dynamics. It's just a fact of life. You've heard a lot of discussions on that as far as who is to blame for the increase in oil prices. And again, where you have to be cautious with all these different discussions, it's not an all or nothing discussion. There's dynamics that are increasing all through. Again, a lot of people highly agree with it. We need to get off of the fossil fuel world we live in. The question is how quickly do we get off that? And what does it do to our pricing? And what does it do to production domestically? The good news is this chart has shown that over the years that has increased. So that is a good thing. That chart is a positive when we look at it. So the key point here is that we do have oil production here, energy production here locally. Domestically, we're not importing it all from across the world. So we are a little bit more energy dependent than we were. The question is, where does that go in the future? And how quickly do we try to change our sources? Okay, next, I want to talk a little bit about COVID. When we look at COVID, very good news from this front. So if I want to say the key point here is that COVID is not as big of an issue as it once was. Back when we were going through and developing and getting prepared, coming out of late 19 into the 2020 and going through 2020, this was the huge issue. Now, what we've seen that when you look, for example, I was just reading where, our fatalities are down to below 1,000 a day now, which 1,000 still is a big number. But what we've seen is we have seen that these numbers have come down dramatically, which was a major part of what we had in early 2020 when we saw that cases were going up dramatically. We were shutting everything down. Because what you have seen over on this chart here, we have seen that we've had a big increase in hotel. I mean, it's still not what it was, but we are seeing that from what it was down to when we saw the minimums, we are up. We're not at capacity yet, but we are seeing, for example, one of the things, and I'll talk about this later on, is like with consumer debit and credit transactions, we've seen those increase dramatically. So we are seeing that people are spending money, which is good for the economy, again, because 70%. So this is definitely a plus when I look at what's happened with COVID. I mean, that is a situation that is a plus. Next, we take a look at what's going on with just economic growth in general when I look at GDP. So when we talk about what's going on with economic growth, we've seen that we've exceeded our pre-recession levels by about 3.2% of what we had. So before we went into 20, we've actually seen GDP come back nicely. You can see it was a big drop here when COVID was at its peak. It's come back quite dramatically. Now, the question that we're all asking when we look forward is, so this number has been a plus. The question is, will we be able to keep that up with rising interest rates by the Fed and trying to control inflation? Because remember, 70% approximately of our GDP is based on the consumer. So that is a big part of what we're doing with our money. What are we doing with our money? Do we have money? Are we raising debt? Are we credit cards going up dramatically? We're not paying them off. All of that goes into the consumer part of the world that we have. Okay, the next one, we're going to talk a little bit about unemployment and wages. Again, this has been a plus. So when you look at what's happened with unemployment, we have seen that unemployment has come down dramatically. When you look at now, again, rate-wise, the 50-year average is 6.2. Now, one of the things also, I always want to caution people, when you're looking at these charts and graphs and everything, it depends on a little bit what perspective you're trying to make too. I try to look at them as agnostic as I can from a number standpoint. And I was mentioning to someone in the office the other day, we have our political divide between, the left and right, and just people get very fired up on their thought process. I honestly have seen that sift through to certain economists that I look at over the years. Again, if you let your whatever point you're trying to make dominate your thought process, because there's many ways you can interpret these numbers. I mean, unemployment has come down dramatically, which is much lower than what we've seen. We've seen wage growth. So when you look at these numbers, the question is where do they go from here? We've seen wage growth go up, which has factored in inflation because of the shortage of workers, the demand. And remember, inflation is a supply and demand event based on how much pressure there is on the price of goods and services. And we have seen that that's increased. Now, good news is if wages go up, people should have more money to spend. We have seen, again, unemployment go down to a degree. Now, the question is, as we go forward and the Fed starts tightening, what is that going to do to the prospects going forward? And again, this all factors into what we see with inflation. But again, it has been relatively good news. And you look at historical averages, we've seen that our numbers here are pretty solid when you look at what we're seeing with wage growth and with unemployment. So those are some things that we want to let people know, that unemployment at 3 or 4% is a pretty decent number on a historical basis. But when you're seeing that inflation is here, how is this dynamics of that going to work? The next chart I want to look at is kind of sources of earnings for companies. Now, this is very good news. Again, I got to put this in the plus category from this chart. When you look at earnings per share growth year over year, we have seen that basically what you've seen, I mean, if you look at these numbers here, we've seen that our earnings per share have gone up dramatically. So as the S&P 500 companies are announcing earnings, they have been very solid. Now, the question is this going to continue? Now, one of the things, and again, this is more a little geeky on my part, but when you start looking at where that has come from, you see it's kind of interesting because a lot of the earnings it's come from revenue. I mean, revenue is increased when you look at it. But when you look at, for example, a lot of it has come from margin. I always use the example of my daughter works at a place called Ryerson Steel in West Dallas. They had their best year ever last year. It was a great year for her, both personally and for the company, due to the fact that what happened is their revenue was up because their margins were up dramatically. Their sales were good. I mean, they had solid sales. Problem is they couldn't get supply, but even with the supply they could get, and I think you're seeing in these numbers, you're seeing that revenue did increase because the margins were there. They were able to get more margin because of the demand. And if they could get enough supply, it really looked good on the bottom line to the earnings of the company. So that, I guess, is a plus. But the question is, are we going to be able to continue those margins as we see interest rates and things change? Now, if supply chain opens up, also, if we start getting our supply routes back on track, that's also going to affect their pricing because there's going to be more supply of steel, for example, in that example, because there was a limited amount and you can basically charge a higher margin on it. So that to me is a kind of a key chart also. Next, I want to take a look at inflation. Now this is, going back here, inflation, there we go. Inflation really is an important chart that we cover right now. So when we look at inflation, that is a number that is probably the biggest area that we have to figure out how this is going to play out. Because this is one that right now, no one knows how this is going to play out. I sit and, it's my job and I enjoy it, reading about all this stuff on an ongoing basis. There's so many views. I mean, you go to the Fed chairmen, each of the regional Feds, they disagree dramatically on what's going to happen. But when you look at what's happened with inflation, we have seen, for example, the March numbers just came out and we're 8.5% year over year for the CPI, and then core inflation, which takes out energy and food, which again, I've always wondered, the reason you take it out under core is because it's so volatile, it's hard to benchmark time to time. But it's a big deal to us because we're buying food. I mean, gas is up 48% year over year, basically. And bacon, which I thought I'd throw in as a stat, is up 18%. People love bacon. So we've seen that happen. I mean, the salmon I like to buy at my Metro Market is up from $4.99 to $7.99. That's real inflation. That takes away your purchasing power when you're walking out of the store. Now, why have we seen inflation go up so much? Why are we now in March at 8.5% and 6.5% on core? Due to the fact of, again, supply and demand. Now, there is a factor with what's going on in Ukraine. I mean, that is affecting kind of the international layout of what's going on with inflation a little bit. Now, again, you look at Russia and Ukraine, even put those two together, their GDP is very minor in comparison to us. Honestly, if we didn't even participate with those two countries as far as trading, it's not a huge deal. I mean, it's not like Russia, although a big geographic country, has not been a big GDP country just due to the fact of all the, dynamics they have going on in their system and their political system that they have. But when you look at this, it is an area where we look at inflation. This is what the Fed wants to get under control very quickly, because this is always one of the areas when you're in these, start to see this happen. And again, it's happened in the past. You go back to, a lot of us remember this era back here if you've been around for a while. It's happened on other occasions where we start to spike up. What they'd love to see is they'd love to see this line about 2% just keep going across the board. So your goal is, the Fed is to have a constant inflation rate. Now, you do not want the Fed not to address this. I've had a client ask me the other day, said, well, why do we need to take these dramatic actions with interest rates and monetary policy, pulling cash out of the system? Because if we don't, if we let this get too out of control, it is one of the biggest taxes to the consumer that there is when all of a sudden your gas prices are up, your food prices are up. Then if it starts reflecting in everything else, which it will, then you see that just across the board. And plus, when you have this labor shortage to a degree, supply chain shortage, that all is accelerating this. You throw in the Ukraine, what's going on there. Those are areas that we do need to make sure that we do pay very close attention to. So this right now is definitely the big negative when you look at what's going on. I mean, this is one of the areas that the Fed has to address. So it's a key item that we're looking at on an ongoing basis. Now, when we look at interest rates, basically what we're talking about, I mean, the Fed is talking about a pretty dramatic, at the March meeting, the Federal Reserve, went up 0.25%. You're looking at going forward, they're talking about possibly 5 increases as we're going forward. So the question is what are we going to see as we go forward with interest rates? What is the Fed going to do as far as addressing the interest rate environment that we have on a long-term basis? Now, one of the areas that no one knows right now, we know we're going to have increases, but the balancing act that they're going to have with these interest rate increases, what is it going to do to our economy? And again, if they don't, you always hear the analogy of landing a plane. If they don't land this plane correctly and they come down too hard, I mean, that's when you start seeing a crash. I mean, then the plane all of a sudden is not doing well. Your goal is to try to have a soft landing when you're trying to control inflation, which is a lot easier said than done, especially when we've had, and again, this is where I hope the political realm stays out of the Fed realm, because again, we're going to have some pain. I mean, I showed the chart back to the, go back to the late or the early 80s. I mean, those were painful times for people that were in the world at that time in the economy. The interesting part is I talk with people under a certain age. They've done nothing but experiencing pretty solid lower interest rate environment that we've had. Now, why are interest rates important besides the Fed policy, besides controlling inflation, and taking a hawkish stance? Now, one of the keys that I mentioned, and I just did want to spend a little time on fixed income and address that, why you see us looking at the bond portfolio so dramatically. For example, these are just asset classes as far as treasuries. Then you have asset classes and bonds that aren't treasuries. For example, if you look at U.S. high yield, basically year to date, a benchmark that's used for U.S. high yield is down 4.84%. As interest rates go up, current bond values go down. Now the yields go up because you're able to go out and get more for current bonds that are coming to the market. But if you're already a bond holder, what happens is you see those values are going to decline for a period of time when interest rates are increasing. So when we know that interest rates are going to increase, it tells us basically here through a thing called duration that if there's a 1% increase, what is it going to do to certain holdings? Now, historically, there's been certain holdings like convertibles and leveraged loans, we call them floating rate. They've done better. You have things like tips. Now, usually the reason we like tips is they do adjust with inflation. You can see, again, looking back on the yield curve with a 1% increase, you just have to be cautious there to make sure that timing-wise, you're looking at those at the right time. But overall, I do want to make it aware when we're talking about, so whatever a person is doing, and I know there's some non-clients on this call also, just make sure that you're paying attention to that bond portfolio. Again, there's certain things that doesn't mean you get out of all the bonds you're in, because they do over time will be fine. It's just that you have to be just aware of what's going to happen and what your duration is. That's the big D number we look at with bonds. What's going to happen when we see a 1% increase? Now, the reverse side, when rates were going down over the last, 15 years or so, we've seen that as these rates were going down, that was a plus for this. We were way over in here with a lot of this stuff. So when we're looking out on the bond side, it is something that's very important to us. Get rolling here. Just quickly, price to earnings ratios. Currently, this is where we're at the end of March in relative terms. If you look over the last 20 some years, we are a little bit high. It's not a bad thing. We've come down a little bit in price to earnings ratios. All it's meaning is, what are you paying for the stock you're buying for the earnings the company is generating? We do watch that pretty closely. Again, it's not biblical. And you can see the 25-year average is around 17. So we're a little bit high on average. It just means one of two things happen with certain stocks with their price to earnings ratios. If you don't have earnings ever in a company, you don't have a company. So eventually what happens is that you do need to see the earnings support the stock price. Certain companies you take a flyer on and you don't care that much about that stock price. Next, we take a look at what's going on with value versus growth. Quick summary on this one. As the economy starts slowing down, you head more towards value. As the economy accelerates, many times you're willing to pay for more growth. Very simple thing that I look at with that. So that's kind of the key point on that slide. Okay, keep moving along here. Point here is international equities. Some of the valuations in some of the other countries are actually a little bit more attractive than ours. When you look at, for example, we're at the 19.5. You look at Europe, they're lower. You look at, for example, emerging markets, China, and again, that's a whole nother hornet's nest in many cases. But you start looking at, are there areas where internationally, we did feel going into this year that international might be an asset class. The whole Ukraine thing kind of threw that off so far, but it is something we're looking at possibly emphasizing more. Another chart quickly here is to take a look at consumer confidence. This actually is quite important. We have seen that consumer confidence is a negative. It has come down fairly dramatically. So the consumers are not as confident as they were when you look back relatively short period of time when you start looking from here to here. Now, what you'll find is, again, it's relatively logical. You're not real confident when we had the housing bubble. And you're not real confident when we have certain things happen. The bottom line is, one of the things you look at with consumer confidence, when it gets down real low, sometimes that's the time you start getting a little bit more excited about what's going on too. The question is how low does that go? And with inflation and some of the moves, that is something that, in just the general kind of tone, especially with the war going on, is something that we are watching closely. So right now, that is definitely on a negative side. Again, really, one of the areas here, and I summarize this slide real quickly, one of the areas that is starting to worry me is I am seeing that although income is up because of the wage pressure and we've seen an increase in wages, I am starting to see that inflation has eroded away at some of that purchasing power. So people that are starting to see that they're making more, excuse me, I go from $15 to $18 an hour. If I'm seeing gas and everything else increase, that does worry me that we are starting to see some of that. So that's a bit of a negative that I have. Next, I take a look at what's going on with inventories. This has always been a main one to me, and this definitely is a negative. We've seen that inventories have peaked to a degree and are starting to come down. What that means is that, have we stocked the shelves up to a degree? And are we going to need to keep manufacturing to keep the demand if the demand is dropping? So we are seeing the consumer maybe isn't as confident, is raising their charge card levels. I was reading that basically we've seen a fairly dramatic increase in charge card balances. And we've also seen not a dramatic increase, but a slight increase in people not paying as quickly on their past dues. So what that means is that a trend line? Not sure, not convinced that's the way it's going to go, but it is get to be a little bit disturbing. Now, actually, it's good for the charge card companies because they're actually collecting more fees when people don't pay. If everybody pays their bills every month, it's not quite as good for them. But this is one that is beginning to worry me, so that's kind of a negative. We look at what's going on with new home sales. This is an important one. We have seen a bit of when you look at new home sales, you look at what's happening with the markets, there is usually a direct correlation there. And we have starting to see that thaw a little bit, where things are not selling as quickly on the new homes. I know the existing homes still seem to be flying off the market here fairly quickly, but as interest rates go up, I mean, I was looking, for example, at, we're starting to see that 30-year edge over 5, fairly good increase from what it was the year before. So those are things that we have to look at. Next, I want to talk a little bit about just briefly monetary base. This is actually a very important chart. I always go back to M1, M2 in college back in the early 80s, late 70s. What happened is this became out of vogue to talk about your monetary base, what's going on with how much cash is in the system. Bottom line is when you get a lot of money in the system, it usually means inflation. You get a lot of money in the system, it usually means inflation. So those are areas that I want people to pay attention to. And it is an area where we are seeing that, fortunately, when you look at the monetary base, it has started to come down a little bit because basically when you look at overall, if there's so much money in the system, and that's why I'm a little worried about, I just hope the political world doesn't force money to go back in that system. It doesn't all of a sudden say we're going to put another stimulus of 2 trillion or 5 trillion or 50 trillion or whatever, politicians like to do to make themselves feel good. Because that, there's a lot of debate with the last time with inflation, did the last 1 point some trillion we put in and stimulus checks going to everybody, did we really need to do that? And that's a question. And again, inflation, we were talking about a soft landing on inflation. It was transitory. And again, the Fed probably missed the boat a little bit this. Some summary on some key numbers. When you look at, I talked about inflation, some of these charts, let me get by these quickly. It looks like we had some doubles in here. Now, when we talk about the business cycle, that is an important part of what we do. When we look at the business cycle, that's something we base off of. Now, growth in the first quarter, again, showed the economy did expand about 6.9%, which is a solid GDP number. That brings us to a GDP rate of a 37-year high. So last year was a solid number. The question is, what is it going to be going forward as we raise interest rates? We are expecting a slowdown in GDP. The question is, how much will that be? So on the growth side, when we take a look at inflation or jobs, we have seen that unemployment rate has dropped. We've seen it happen again. Labor participation rate ticked up a little bit. We are seeing that, when we look at the participation rate. Wages, again, have grown. They're 5.6% higher from the recovery a year ago. Labor force is also growing. Now, the question is what is this going to do from the standpoint of are we going to continue to need as much labor as we do? Now, probably yes, to a degree. I mean, we do have the baby boomers that are phasing out of the workforce, and there is going to be somewhat of a pressure on labor to fill a lot of positions we have. Inflation, I talked about that quite a bit. And again, the number we just saw as of yesterday was much higher than what we thought it would be, and there's reasons for that. Again, we don't know if the Fed's flying of this plane is accurate or not. Again, the transitory, I think, was proven wrong. We thought it would be gone right by now. It's not transitory as what we thought it was going to be. Now, when you look at the rates, I talked a little bit about rates going up. We have seen those increase. Again, I know mortgage rates are up about 1.5% from what they were a year ago. What is that going to cause? The Fed is talking about raising rates as much as 5 to 6 times. We saw a 0.25%. Now they're talking about another 0.5%. The question is what is that going to do to slowing down the economy? Overall, consumers are spending. That's still a positive. I'm seeing a little bit of a worry that, how much debt is going to be there if they keep spending money they don't have. That I'm going to watch that number very closely. Again, remember, consumers are 70%. So as consumers slow down, if they do slow down their purchases, then what are companies going to do with their inventory? And that's why I talked about inventory. Okay, again, business cycle. We have us about right here right now, heading down this way. Again, this is when you start having more value, you start getting into growth before you hit the bottom, then you start coming out of that. So the question is again, this is not an easy thing. If we all could time this, we'd be quite wealthy. It just does not work like a clock and tick like a clock, but it is the best you can do in my pushing 40 years of doing this. It's the most factual thing you can look at. Okay, so summary, I'll take a look at some risks, heightened geopolitical risks that we have with Russia. How long is this going to go on? What is that going to do? And I mentioned this because I do think besides just the human carnage, which is it's just hard to fathom and see on a daily basis, what does that do to consumer confidence? I mean, what is that going to do to our overall feeling as consumers? I talk about inflation. I've kind of beat on that one quite a bit. It is a big worry. And again, the Fed is removing some of this support, low interest rates, a lot of money being pushed in the system. And I know, again, depending on who you listen to, there is a desire to want to push more money in the system, which honestly, in my mind, is the worst thing we could do at this time as we go forward. So we look at the bottom line, use earnings as a guide when we're looking at investment ideas. I think there's still very solid companies, especially on the value side, we can look at and emphasize. It's not an all or nothing game ever. Fixed income, we do have to watch the duration and to a degree quality a little bit. And again, internationally, there's some things I'm going to like there. The war has kind of changed that a little bit, but when you look at PE ratios, falling dollar, that usually bodes well on the international side. Inventory corrections, we'll watch that. The consumer, rising interest rates, those types of things as we go forward. As we look at the last part, and I'm not going to spend a lot of time on this, but I do want to let you know, and we are constantly expanding our horizon as far as different concepts and ideas. One of the things that I've been looking at is protecting on the downside. So many of our investors are in retirement or approaching retirement, living off of income. The part that we have to be cautious, we just do not want to get clobbered on this side. I mean, we want to participate on this side, but we just don't want to get clobbered here. There are some products that have come to the market, and honestly, annuities have had these for several years, but now they've taken them out of annuities, and we can get ETFs that do have some protection with them, where they protect some of the downside and limit your upside. But for a lot of clients, I'm thinking of those maybe ways that we can, depending on how you feel about fluctuation, take a look at doing some of those things. I'm not going to go into that in a lot of detail now, just due to the fact it can get a bit complicated. But I do want to let you know I will be talking more with people about concepts to help protect as we see a lot more volatility as we're going forward. Just a picture of the advisors that we have. Mike is also still with us for clients of Mike that had been clients of Mike. He's still a consultant with us. We just didn't get his picture on here, but he still is, we have access and work with him. So again, I just wanted to recap a little bit of the webinar. Need to update your beneficiaries, some things that we want to do. Inflation is real, interest rates will rise, and just the cost of doing business. The question is what is that going to do to that as we go forward? If you I do want to take a few minutes and look at questions here. And just for anybody, I know we have had some people that have had problems getting in. And honestly, we're getting a bit impatient with Zoom as a provider for these webinars. We may be looking at it as an alternative in the future because it seems like we've been having some issues with our Zoom. So if you weren't able to get in, you're not on this call, and I feel bad about that. So just something I'm going to put it out on the file that we post out on our website. So for people that couldn't get in and are going to watch this after the fact, again, I always want to make sure that they understand that. Let me just take a quick glance here at any questions. Okay, I'm really fearful about interest rates going up and up and up. At what point do we need to raise? When will that kill inflation? Nobody knows. I mean, the bottom line is it is a necessary medicine that we have to take. The question is how long is it going to go through the body and start working? They're talking about some pretty dramatic increases. Now, those should be able to see them start to slow things down, because that's what you're doing. I mean, however you want to paint this, and no politician ever wants to paint it that way. When you raise interest rates and take money supply off the table, your goal is to slow the economy down because the pressure it's putting on from a supply demand side. That's simple. I mean, we can make it sound as complicated as we want. That's what you're trying to do when you raise interest rates. Now, it's a balancing act. Now, the question is, if we go too far, will it push us into a recession? Again, I have no crystal ball in this, but I think there's a, I don't know if it's 50-50, but 40-60, at least in my mind, that we may slide into a recession. And we won't know it till it happens. But that's why we need to make sure that we're identifying that risk. But again, our goal from an investment standpoint is always making sure we have money you can get at if you need it. We have money that's more of a medium term, and then we have stuff that's longer term. Again, some things, if they go down, you still don't want to sell them. Again, market timing. Again, I've been in this business a long time, and personally, I've tried market timing in my personal portfolio. It is a tough game to win because of the volatility and the irrational basis that you see. So it's one where we don't market time. We do use market logic and let the business cycle help us with a slant, but we are still going to use, such things as looking at asset allocation. Another question, be frank, did the government spend too much and has the Fed been too slow to raise interest rates? Yeah, I think so. I mean, I think yes. I think the transitory line was off. And again, it's easy for me to say in retrospect. I thought it was off at the time because we were probably due for some inflation. But it is one where, yes, that's why they're taking the action they're taking. Now, the question is what is it going to do? Is GDP going to continue at the rate it has been? Well, again, the pandemic changed that whole dynamics of coming out of that and seeing the GDP we saw. I mean, a GDP of that, 4% range would be a nice one to have on an ongoing basis. Are we going to stay in that range? Again, only time will tell because of the dramatic. Now, a lot of that depends on what's going on in the world, too. I mean, on a short-term basis, some of these geopolitical things do make a difference. Okay, let me see other questions. About a recession, do we anticipate one? I kind of covered that. Those are the main ones that I'm seeing out as far as questions. I know we're running at about 40 minutes here, and I try to keep the discussion to about a half an hour and then kind of cover questions here quickly. If anybody has anything more, feel free to put those in. Now, as we go forward, if you know of anybody else that would like to listen to these, we do post these on our website, so they are available. Again, I'm covering this on a very high level. I have much more detailed information that we'd honestly be here till next Tuesday or Thursday, probably. What I want you to have a feel for is there is some clouds. How is there going to be a storm? Not sure. I think there's going to be a bit of a storm. How severe it's going to be? Is it going to be a hurricane? Are we going to experience some of the massive downfalls? Overall, I'm not predicting that the markets are going to go into a massive crash here. But I do feel that we need to be aware of what can happen. Again, can is a word that's hard to classify in this environment. It's one where the Fed's increases will have an effect on what's going on. The good news is that we still have some inventories to build up. I mean, we still have some production to get out there. We still have supply chain things to kind of work through in certain industries. But what's it going to do to the consumer confidence? That's a big one. If you have any questions, always feel free to make an appointment with us. We're always available. So if you'd like to set up a review, if you're a client, if you're not a client, and you'd like to just sit down and kind of go through this stuff, again, what we do is we look at financial planning. So what are your goals? What are you trying to achieve? We review your risk tolerance, how much risk you're willing to take, because everybody has a different definition of risk. And part of that goal setting is time frame. What's your time frame on your assets? And that should always be a key question of how you invest money. If you walk in, you've got $10,000 and you say you want to invest it, my first question is, how long is it going to sit there? We have to make that determination. But those are the process that you always should go through. Anybody that ever leads with a product, it just makes no sense because you have no idea. I mean, again, using the doctor analogy that's used a lot in our industry, you walk into a doctor, they don't, cut off your arm right away because your hangnail hurts. I mean, it's one where we have to be logical about what we're looking at. How does it work within your situation, your goals, your time frame? I appreciate everyone's time. I know we are running at 45 minutes, so I do want to go ahead and stop at this time. Again, feel free to give us a call with any questions. And everyone have a great day.